clearly was HUL after reporting a good set of numbers. 6% volume growth was far better than the 3 and 4% that they were reporting earlier. Varun Lohchab, Regional Head of Consumer at CIMB Equities, joins us now to talk about that. Varun, the stock reacted to the numbers, was up 3.5% on Friday. How much more would you give it based on these earnings?
I think numbers were, a tad better than estimates on top line, but you have to also keep in mind the base, which was quite favorable in this quarter, both for volume growth and for PP. So I think adjusting for base and one-off excise refund, I think numbers were in line, which is okay in this environment on a relative basis. But on absolute basis, we believe valuations are pretty full. So we have maintained our reduced rating on the stock with a target price of 750. So we don't see much upside from current levels.
Okay, you don't expect any improvement because of, say, raw material prices or what one brokerage has called a premiumization trend? No gains in margins or realizations to be eked out?
So we are building in a fairly decent margin expansion even in FY16 and 17. So if you look at over next 2 years, we are building in almost a 150 bips margin expansion, which is pretty considerable given the fact that they have already improved their EBITDA margins by around 300 bips in last 3 years. So and on the premiumization bit, most of their premium brands are doing better than their mass end brands, which helps in terms of overall realization growth and profit growth. But we believe that is more or less in numbers. So what we are building in is that top line growth will be around 11-12% in FY16, which itself is a decent improvement compared to current levels. So it is on back of some improvement in volume growth, some improvement in realizations going forward.
What could that improvement in volume growth be, Varun? Because the management also on the call stated that it's too early to gauge the impact of unseasonal rains on rural demand, and we've seen it across the board that there's not been too much of an impact on rural demand that was visible this quarter. But next quarter onwards, what kind of volume growth are you forecasting?
So see, our view is that first half of FY16, it will be difficult for them to sustain even the current, top line trajectory. And overall for full year, we believe volume growth is unlikely to be above 6 to 7%. So our view on overall macro consumption trends remains negative, which is why we have a sell on, most of the consumer staples. Because we believe recovery would be fairly delayed, which is again something which management also confirmed on the call that, there is no trend as of now of overall recovery in either urban or rural. And on rural, they also highlighted that probably risks are a bit to the downside. They need to see how the monsoon goes and all. So I think on top line, clearly volume growth and to expect anything above 6 to 7% would be difficult in FY16, which is what we are building in. And 6% in this quarter, you have to look against the base of 3%. So I think on a normalized basis, the company has been in that 4 to 5% volume growth band for almost 6 quarters now.
Fair point. Well, actually, now that we have you with us, let me just extend this argument. Titan, I mean, gory numbers one thought from such a marquee company. Sell?
So, Titan numbers were clearly disappointing for Q4, but, again, you have to look at it, in the backdrop of the fact that, Golden Harvest scheme is not there this quarter. So numbers were expected to be weak on jewelry, but they were a bit more, sort of on the softer side compared to what we had estimated. I think, in terms of valuations, it is starting to look a bit reasonable, but still not attractive enough for a buy. So we have a hold rating on the stock, which we have maintained. We believe numbers will start to look better from second half when the base gets favorable and the Golden Harvest scheme impact comes in the base. But first half again is not expected to be anything significant, but it will be definitely better than this quarter. And we tend to agree with the steps that management has taken, in terms of reducing the making charges on the plain gold jewelry, which I think will make them more competitive against other brands. So I think they are taking the right corrective steps from the longer term point of view. but it will take some time to reflect into the numbers.
Okay, let me rephrase the question. Is there any buy for you at all in the FMCG, in the space that you look at? I mean, Kanza and Nerolac numbers were looking okay over the weekend. Anything at all that's a buy?
See, overall, in terms of our ratings, it's only ITC among the staples where we have a high rating, which is effectively a buy rating. Which again, post the current fall, we believe risk reward has become fairly attractive on ITC. So ITC is a buy, and Jubilant Foodworks we have a buy on. So I think apart from these two, most of the other names are either hold or sell.
Not even a buy on Dabur, which had a very good set of numbers this quarter?
No, so Dabur again we had downgraded a few quarters back, and Marico again we had a buy till now, but we had recently downgraded Marico after this quarter. So, our sell rating on most of the staples is on the back of the view that, the recovery in consumption won't be fast enough, margin expansion is already built in. So I think on a relative basis, yeah, Dabur, Unilever, Marico, they are executing well. So if one were to pick some stocks, probably they are, in the top half, I would say, from an execution point of view. But absolute valuations look stretched all across the board.
Fair point. Pleasure speaking with you, Varun Lohchab. Thank you very much for joining us.